All right, folks, now my next guest says that winning, it's all right. It's not cracked up to what it should be, right? Well, so he really is saying is beware, right? Beware of short-termism. I'm going to bring in now Manulife John Hancock Investments Co-Chief Investment Strategist, Emily Roland. All right, 2026, the outlook. Winning isn't all it's cracked up to be.
That sounds so bearish. I didn't write it exactly like that.
You didn't? Okay.
No, but the idea here is that 2025 has really been this sort of short-term investor's dream market. It's trend following, it's momentum, it's technicals. It's buying a chart that's going up and winning.
Right.
It's just been incredible.
Chasing is
chasing
returns. I mean, I was surprised that someone from Boston, right? You guys have won a few championships.
Yeah.
Yeah. But this is the thing that bothers you, the short-termism here. Unprofitable tech, retail favorites, crypto, even foreign countries where there's not necessarily a lot going on, but they've made money.
Right.
So the problem, I guess, with short-termism is it's gone on for a long time, and trying to predict when it's going to end is hard. I guess like musical chairs. Yeah.
So that's why it's all about sort of finding a solution between the short term and the long term, because long-term investors are like, wait, the market's totally overvalued. Just talk to Shanali about that. They're seeing this sort of frenzy build in crypto and other related assets. It seems like a giant misallocation of capital. So how do we put those two things together? And to us, it's really about drafting the market. And I know we were going to talk about that in just
before
a minute.
we do, let's just talk about some positive sentiments. So these are things that have helped the market this year, and it feels like they should help next year, right?
Yeah, so these are things we're actually looking at into next year.
Okay.
So corporate earnings, 14% is what's being penciled in by the street. We think we can do it. You've got the dollar that's weakening. Remember, 40% of the revenues of S&P 500 companies are coming from abroad. There's a huge advantage to that translation. And then we've got fiscal stimulus in the form of the one big beautiful bill that's going to be really accretive to profit margins as well.
So drafting, we know what it means in automotive, right? So essentially you're saying you don't want to be this guy here. You want to be this guy. You want to be this for right now, because at some point you'll be able to zoom by. I guess, am I doing this right?
Kind of. And by the way, when I wrote this analogy, I didn't actually know that much about race car driving. So you've already put something more technical in front of me than I knew. But the idea was basically the market's been in fifth gear this entire year. But you've won by taking a ton of risk. And you don't necessarily want to be that lead car anymore, because you can risk an accident. You don't need to be out front. So it's just about being just behind that lead car, drafting the market, having that beta, but just being slightly behind and participating.
So we're talking here about cyclical, defensive. This is what you like. This is where you feel comfortable. This is where you draft in these areas. Although, I mean, from time to time, they get pretty hot themselves.
Yeah, well, we're starting to see that come back. In fact, in the third quarter, areas like healthcare and industrials had the best earnings growth across S&P 500 companies. But these are high-quality, relative value plays. So this is where you're going to get great return on equity, great margins, great earnings growth prospects, and you're going to get something totally different than technology. We still like tech, but we want to broaden it out.
So it sounds to me, in a nutshell, 2026 will be an up year.
Yep.
Not as much as we've had in the last few years, which is fine. But the key, though, is that you're going to have a changing of the guard, so to speak, and you want to make sure you have exposure to those areas.
Yep, you want more breadth in portfolios. You also want to think about letting bonds do a little bit more heavy lifting in portfolios. There's $7 trillion sitting in cash right now. That's been by far the most popular investment, has been money market funds. I think those rates get chopped down into next year. So if you can lean into the intermediate part of the curve, embrace a core or core plus type strategy, you have the ability to lock that elevated income in, 4 to 5% on high quality bonds. We like that, and build that return stream that can last for your clients.
Good stuff. You've been away too long.
Great seeing you.
Thank you so much. Merry Christmas.
Merry Christmas.
All right, folks, we'll be right back.